Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to be joined by Mr. Yesar Maleki, Gulf Analyst with the Middle East Economic Survey. Welcome, Yesar, welcome to the show.
Thank you for having me, Shane.
One can't really talk about anything this week without kicking off with all things Ukraine. It seems it is the biggest story in the world at the moment, impacting every market and every commodity. I'd welcome, as a sort of starting point, your views on the Ukraine crisis, its impact for the energy markets, and does it have a domino impact, you think, for the Middle East region?
Well, I mean, we have seen lots of Brent volatility yesterday, which was reflecting on the ongoing crisis in Ukraine. There is a premium to the risk, which is adding up to us reaching to the $100 per barrel mark. But we were expected to reach that anyway this year for a variety of reasons. Now, the question is, this is great news to many oil producers, but at the same time, it may lead to demand destruction, and many of the OPEC producers are quite keen not to see that happening, but at the same time, they have their own problems when it comes to spare capacities and their inability to max out their production according to their plans. But just to focus on the Russia-Ukraine crisis, what we need to understand is that the US this far has declared sanctions that would target Russia's financial sector and members of President Vladimir Putin's inner circle. And they did that rather than, sanction. They didn't want to disrupt the supplies of Russian oil and gas into Europe and potentially push elevated energy prices even higher. So this is the good news. Now, the bad news is that there are many IOCs and oil trading houses that have ties to Russia, and they are sooner or later going to be caught up in this crisis if it expands further. So you have names like BP, ExxonMobil, who work with Rosneft. You have Shell, which works with Gazprom at Sakhalin 2. You have even trading houses like Trafigura and Vitol, Total Energies at Yamal, and so on. So the West.
So you think that if indeed the crisis with Ukraine escalates, then it will be unavoidable to bring the energy sector into the sanction list?
Well, this is not what the West wants to do, because by the end of the day, they are reliant on Russia. US imports of Russian crude and products back in November 2021 were around 595,000 barrels per day, according to the latest EIA data. So does the UK and the European nations. They rely on Russia. The UK imported about 13% of its oil and products from Russia in 2020. And this does not include imports of products that were refined at European facilities. The EU relies on Russia for almost 25 to 35% of its crude imports, and even previous sanctions. So, the sanctions that have been imposed are already in line with the previous sanctions that were put on Rosneft, for instance. So, after the annexation of Crimea, the sanctions were designed to allow continued exports of oil, but simultaneously attempt at curbing production growth in the future. So the Russian giant was unable to access Western financing with maturity beyond 90 days, for instance. Now, targeting Russian banks is an important indicator of what's happening, especially if the West tries to kick them out of SWIFT. It will make it difficult for Rosneft and other oil producers to access cash, both domestically and from partners, also complicate trade payments. But until now, key banks like VTB, Sberbank, Gazprom Bank, they were not included in these sanctions. And these banks are key for oil and gas and commodities trading. So Russia, there is an important point here. Russia knows well its key position in the energy markets, especially for the West, and understand that the weaponization of energy commodities may backfire on the Russian economy long term. So it's a two-edged sword that Moscow is too intelligent to fully utilize to the disbenefit of its political adversaries. At the same time, the West doesn't want to go to this doomsday scenario. So we are here in the middle, pivoting between these two places. And I think it is business as usual because the West
Certainly,
is
certainly the markets have responded relatively timidly, at least thus far, and hopefully until we publish this interview. But the idea that the sanctions or the reaction from the initial reaction from the West has been fairly muted, and consequently the markets don't see an escalation perhaps, and so consequently are playing it easy. Let's move on from that. You had mentioned in your earlier comment that oil prices are destined to reach $100 anyway. So ultimately, you must see a very tight market. There's a sense of kind of forecast that 2022 Ukraine on the side, but ultimately 2022 was going to be a year of two halves. The first half very tight, the second half would ease up. Do you subscribe to that narrative? What is your outlook, and why do you advocate $100 oil?
So, I mean, first of all, no analyst advocates any price. You know, by the end of the day,
or you see $100 oil.
You see 100. Yeah, exactly. If I had a crystal ball, I would be very rich, Shane. But anyway, there are many factors, you know, that contribute to the analysis that we were going to see $100 per barrel anyway this year. So, as I said before, many OPEC plus countries were maxing out their capacity. You know, we already have seen that starting in December. Uncertainty over the Iran nuclear deal, how much oil can be brought into the market, and uncertainty over Libyan exports, interest rate hikes, and their effect on disposable incomes and household spending. This is a big issue. Uncertainty over US shale output and availability of financing for the shale patch. US driving season is coming soon in summer, and gasoline prices are already high. We're seeing recurrent refinery fires and shutdowns. In the US, there is a rebound in jet fuel demand as well in the upcoming summer, especially with countries calling for an end on COVID restrictions and subsequent and there should be a subsequent growth in travel and tourism sectors. And you have the US midterms, which is a big geopolitical factor as well. And what is Biden's policy on the American oil and gas industry? So in conclusion, we were meant to see oil prices at 100 per barrel and maybe beyond, as many have forecasted. And this could have come, as you said, as early as the first half of 2022, but now it is accelerated due to the tensions that we have in Ukraine.
But nonetheless, your comments on Ukraine would indicate that you don't foresee, at least in the current paradigm, that energy supplies out of Russia will be disrupted. And so we're really looking at $100 oil based on fundamentals of supply and demand. You mentioned there in your opening comments that indeed spare capacity within OPEC Plus is limited. My question to you is, how limited? There's a certain belief that Saudi, UAE, Kuwait could go further. Is that your view? Is there extra capacity still in the Gulf countries?
Well, it's, you know, everybody knows that Saudi Arabia and the UAE have the spare capacity. Even the IEA recent reassessment of spare capacities back in January, they gave the UAE even a higher spare capacity at Upper Zakum, and so does Saudi Arabia. So, but the idea here is it's not clear that these countries could immediately bring in that oil to the market, and this depends. Well, they risk fragmenting the OPEC Plus alliance if they do so. And so there is no willingness to risk that. You know, Saudi Arabia has invested a lot in the OPEC Plus agreement and putting everyone together. And we are
why would that risk the OPEC Plus if indeed they, I mean, as you said, every OPEC Plus member, or at least most of them, are already producing at capacity. Why would they be upset, offended, whatever the language would be, if Saudi pumped an extra 500,000 barrels a day, given the tightness of the market?
Well, it's OPEC, and by the end of the day, it is a group of oil-producing countries with who put a lot to their names and reputations. So it is going to be hard to try to push such a deal, asking bigger producers to produce more, and those who do not have the spare capacity to allow that. It's historically hard, and as history shows, it's really hard to bring together the group and make them comply. So it's going to be not easy to do so. But in September, everything is going to be, the cuts are going to be fully unwound, and there might be a new chance there for renegotiating the quotas and the baselines and so on. Also, this is very important, if an Iran deal is struck, this might be the opening for everybody to start to reconsider their positions.
If looking at, before we get to Iran, I just wanted to look at this a little bit more. Would there not be an argument? I mean, obviously in the past, OPEC has quite often cannibalized each other's quotas. It's more normal than not. And on this occasion, would there not be an argument to be made in order to protect the gains that have been secured, to calm the oil price a little bit so that it doesn't drive the bus off a cliff with demand erosion?
Yeah, I mean, there is that argument, but the argument has to be subscribed to by everybody in the group. You mentioned Kuwait. So, for instance, Kuwait has been facing trouble. Their production has gone to I think by 2021, by the end of 2021, they saw some great capacity reductions, and now they are relying on the PNZ, for instance, to add up to their capacity. Iraq is another country that is facing a lot of constraints when it comes to upstream, midstream, and even export facilities. So all of these countries, they understand the situation, but for them to forego their best baselines and allow more for Saudi Arabia and the UAE will require some sort of a concession from the Saudis and the Emiratis. So we have seen concessions, like last time when they extended the OPEC plus cuts. So it is doable, but
do you think there would be a bit of a surprise? I mean, this current agreement of 400,000 barrels a day per month is only entered into in August, and yet immediately within the first month or two, the group failed to meet this increase and has since then failed, never mind to add, as we're talking, but even to meet the current agreement. They're essentially hitting about half of that number over the last 6 months. Do you think the group is surprised? Were the data wrong? That a lot of the producers couldn't meet these new production levels? How do you read this? I mean, again, it only was agreed to in August, and immediately they were unable to meet the production amounts.
Well, I think many of the countries, well, when it comes to data, I think OPEC has been doing quite a good job when it comes to using primary and secondary data. So they could, have a more realistic pictures on what's happening. The capacity declines, they are quite sizable, and they have to do a lot with recent history. So we had the oil price plunge in 2014, 2016, and also the pandemic in 2020. And we have fields that are maturing in almost all of the OPEC countries, and drilling and exploration activities have been downsized. Do they know that? Do they? Yes, of course, they do. But by the end of the day, OPEC is also a political organization where countries need to protect their positions. We will see this very well when Iran comes back to the market, and the Iranians are really good at negotiating and securing concessions at OPEC. So,
do you think we're finally at that point, kind of the the boy who cried wolf. The Iran deal will be done tomorrow, tomorrow, and tomorrow. Are we there now? Does this feel like we're back to the doorstep of a deal?
Well, I mean, everybody has been saying that we are at a critical juncture, right? But there are a lot of issues to be resolved. So the main one is that the Iranians want guarantees that these sanctions are not going to be snapped back. And this is something that, you know, the Biden administration is at no position to provide. So now we are talking about an interim deal to make sure that everyone is complying and, you know, some verifications, the Iranians get some frozen funds, the 7 billion in South Korea, you know, the Americans and the Iranians finally get to, you know, meet each other face to face, some Western prisoners are swapped and so on. But this is all building up to a bigger deal. Even when that happens, you know, and we reach the re-implementation day, of course, there are steps before that. These steps that I mentioned, in addition to one big issue, which is the supreme leader of Iran approving and signing off on any deal. Even with re-implementation, we need 1 to 3 months to verify what's happening. And then if things are re-implemented and Iran is allowed to export, it's not going to happen outright. So customers will need to go back to getting waivers from the United States and so on. Now, these 1 to 3 months, they could happen in weeks though. Because, you know, I think all parties in Vienna, they have drawn the technicalities of verification processes and so on. So there are many ifs. Okay, but I think we are at a very advanced stage, maybe even days away or couple of weeks, you know, from something, whether it is an interim
so
deal
this could be the key, the gateway, if you like, to that general view that the second half of the year, the current tightness in the market will ease, because indeed Iranian oil will return in time for the second half of the year. Would you subscribe to that?
Well, it depends on what Iranian oil. So let's assume that, you know, Iran is back to the market. Let's assume that, you know, they are allowed to export by May, as early as May. Well, many believe that, you know, they could bring in 400 to 700,000 barrels per day in stages. Now, why they can't do that? They have around 60 to 85 million barrels in storage, onshore and offshore. 30 million of that is condensates. Now, 65 to 80 million, depending on who you ask, you know, nobody really knows.
But a sizable amount.
It is quite a sizable amount. But again, the Iranians, they wouldn't just, well, there are two theories. Are they going to just outright dump it all into the market, or are they going to phase it out in stages? That's stored demand. So I think the Iranians will go for a phase out because it is not in Tehran's immediate benefits to significantly dampen oil prices, especially after years of hard currency shortages and lost revenues. And Iran may want to gradually but steadily restore its market share, which it has lost to other producers. Now, there are a variety of reasons to that. You know, they had strong demand before from South Korea to Taiwan, India, Japan, and others, and those countries have switched to other crude since, and they need to prepare. But Iran has been preparing also an allocation list as well, and they have been gauging those customers for some time. Now, this is a stored crude, but what happens after you run out of that crude? So this is another factor in why I believe they are going to phase it out. Onshore production is an issue. I mean, figures on Iranian oil production are really hard to get these days, you know, since 2018, to be honest. It is understood that Iran is producing around 2.55 million barrels per day. That is 1.3 million barrels per day below what they produced in 2018, which was at 3.85 million barrels per day. The National Iranian Refining and Distribution Company says that last year they refined on average 2 million barrels per day of crude. exports, from various reasons, tanker tracking and so on, they put the average 2021 production at 1 million barrels per day. Around 680,000.
1 million export or 1 million total production?
Exports.
Exports.
So we're talking exports here. Exports at around 1 million barrels per day, but 680,000 barrels of those are actually crude and around 320 are condensates. And the Iranians are speaking about, they want to get their crude production capacity back to pre-sanction level, so around 4 million barrels per day by the end of the current Iranian year, which is March 2022. Now, this is all
23.
Good. No, so the current Iranian year, which ends in March 2022. I know, I've been struggling with Iranian years, believe me. I have
to get back to pre-sanction levels within the next month, basically.
Yes, so this is where it is easier said than done. Iran has been facing technical and financial challenges boosting its capacity. So Tehran has resorted over the years to local suppliers to bridge the technology gap and even sought financing from private Iranian investors in the oil and gas industry. But this has returned not favorable results. I'll give you one prime example, which is very important. There is a cluster of fields on the Iraqi and the Iranian borders called the West Karun. And this is central to Iran's efforts to increase oil production. The National Iranian Oil Company has resorted to local firms, Petropas and PEDC, to boost capacity there. And they have been somehow successful. They boosted capacity from 100 to 420,000 barrels per day, but they need to get that above 600,000. The key field is South Azadegan, for instance. It is currently producing 140,000 barrels per day, but technological issues, especially at one under construction central treatment facility, are huge. Progress was supposed to reach 85% back in October, but it is only at 20%. So this is just an example. Now the target is to reach 320,000 barrels just from South Azadegan by mid-2023, and they have been, pushing the goalpost for years. And they only managed to add 15,000 barrels per day just recently. Now, in this example, there are delayed payments, there are frequent plan revisions, there are diversions of funds, So they diverted the funds that they needed for South Azadegan to build a pipeline to their new facility at Jesk. And then you look at Jesk, which is their new terminal on the Gulf of Oman. It also was delayed. Why was it delayed? Because the equipment that was manufactured by local suppliers was not up to spec.
There's clearly huge challenges in rehabilitating the Iranian industry, and perhaps lots of opportunities for international partners who are brave and seek that.
Exactly. So now the NIOC managing director, Mohsen Khojastemer, he said recently that they have a 10-year plan to revamp the sector. Now, they will need $160 billion for both oil and gas. They want to reach an oil production capacity of 5 million barrels per day or 5.7 million barrels per day, depending on who you ask at NIOC, and 1.5 billion cubic meter per day of gas capacity. How much money will they need? They will need 90 billion just for oil and 80 billion for gas for a 10-year plan. Now, these targets are not new. Back when the JCPOA was signed, the Iranians wanted to reach the same oil capacity target by 2017, 2018, just short period of time. But a few foreign firms were willing actually to enter Iran, and this is due.
And what is your anticipation on this occasion? Again, you're talking an interim deal with that it may be structured. Obviously, the Americans cannot give any guarantees beyond this administration. It doesn't sound like the context of a very, at least for American firms, to be confidently moving back into Iran.
Well, I think it's a big assumption to see American firms going into Iran. The Iranians are keen to see the Chinese coming in. The new oil minister, Auji, has been speaking with CNPC and other officials from CNPC and other Chinese companies. And the Chinese companies, for instance, were involved quite at the West Karen cluster.
But there wasn't a very positive previous experience with the Chinese.
No. And it has to do with the contracts, it had to do with targets and so on. But, you know, overall, even with the IPC foreign firms, including the Chinese, they were not, the IPC, the Iran petroleum contract, foreign firms were not that keen to enter the country. So the contractual terms were seen as poor. And NIOC had a lot of control over operations and targets and so on. But nevertheless, the Iranians need the money, as we said, you know, it's a lot of money. Chinese investment is one conduit. Iran has now a broad strategic agreement with China that goes all the way to $400 billion. And energy is quite key in that deal.
Well, we'll have to leave it there and wait to see exactly when this finally happens. And as you suggest, it could be literally within days or weeks. Certainly the soundings out of Vienna are that they're finally there. But the last mile of any of these negotiations can always be the most difficult, given the most complicated issues are left till the end. Yesar Al-Maleki, Gulf analyst with Middle East Economic Survey, thank you very much for joining us on Halftime Talk this week.
Thank you very much, Shane. Cheers.